Good day, Industrial Advisor listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
Welcome to our Industrial Advisors podcast. Bill Condon and Matt McGregor, live at the IAMC Conference in Greenville, South Carolina.
Cool city, by the way.
Really cool city. We got the king of the Inland Empire with us today, Steve Bellitti, one of our favorite guys at Colliers, great friend of ours.
Second time on the show?
Second time on the show. Steve's always one of the top brokers nationally at Colliers, having been number one in the entire company multiple times. Works extremely hard, still working like 60-hour weeks. I don't think is ever going to slow down.
Maybe 70 hours.
70-hour weeks.
Yeah, exactly.
Sorry, my bad. Anyway, just a great guy. And everyone's always interested in the Inland Empire and everything that's going on there. It's one of traditional...
Second most trended podcast we ever did, by the way.
Was the Inland Empire?
Yeah, for
Steve.
1 month. Yeah.
I mean,
people
everyone
were very
cares about
interested.
it. Yeah. And it's a huge industrial market. So why don't we start by you just kind of giving a background of the IE and how it developed.
Perfect. First off, thanks you guys for having me. I always
sure.
love being on the podcast. It's always fun to hang out with two of my best friends here at Colliers and actually in the industry. You know, first and foremost, I'm the luckiest guy in the world to be working in the Inland Empire. The Inland Empire is by far the best industrial real estate market in the U.S. for sure, and maybe in the world. We've had tremendous growth. Our market overall in Southern California is 1.8 billion square feet. So obviously the biggest industrial market in the country.
Yeah.
The Inland Empire, which is really the growth market of Los Angeles, is 630 million square feet. And so over my career, I've been fortunate enough to work the most dynamic market, work a market that's been growing. We grow 20 to 25 million square feet a year. And, you know, mainly that has been driven by really two things. The two things that drive our market are population. Mm-hmm. Obviously, we have 25 million people here in Southern California that buy goods and services. We have the two largest ports in the U.S. And generally speaking, any 1 year, and again, it varies from year to year, about 43% of all the products that come into the U.S. come into one of those two ports.
That's a crazy statistic.
And as you know, we've had with some of the issues with the global tensions impacting the East Coast ports, and also with the issues with the drought down in Panama.
Yep.
We've seen increases in the port volume. So we don't anticipate that really the population going away or the ports are going away. And then what's really kind of been the fuel on the fire is obviously the shift to e-commerce. And that's what basically took our market from really kind of a high-performing market to an ultra-performing market. And as most investors and occupiers see is that, you know, this is the Inland Empire by far is the most dynamic market in the country. And, you know, COVID was a situation where it changed people's behavior, changed people's buying behavior, changed corporate America's, you know, shift from what we've always known to be like just-in-case inventory to just-in-time inventory to just-in-case inventory. And we've all went to college a long time ago, and we all learned about just-in-time inventory. Nobody learned about just-in-case inventory, but for some reason, they took on this new philosophy and started buying just-in-case inventory and storing just-in-case inventory.
Starting when?
Starting about 2001.
Okay.
And that's what kind of drove this kind of artificial demand in the Inland Empire, and probably artificial demand across the country, but most dramatically in the Inland Empire. And we saw our vacancy rate go from a normal market, which is about 4 to 4.5%, down to 0.5%. We saw rents basically in 2 years go from, you know, let's just say they grew about 102% over a 2-year period, something that like we've never seen before. A normal market out in the Inland Empire, we see like 9% rent growth annually for the last 13 years. And then all of a sudden, out of nowhere, we see 100% rent growth. And so that caused kind of the craziness that happened here in Southern California, both from a lease rate perspective and also from values. So where we are today, We're kind of
different?
we're dealing with a little different market, and it's actually been a pretty dramatic shift in our market.
Within what time span?
Within the last, let's say, 15 months.
Okay.
Yeah, 12 to 15 months. We basically had a market that was kind of a market of extremes. We had this 0.5% vacancy rate, which means basically in a 630 million square foot market, there's only 7 buildings over 200,000 square feet, which is basically no buildings.
Yeah.
And that's what drove the supply and demand imbalance. And as dramatic as it has been going up, we've seen a real dramatic impact of that, what I like to call as a COVID hangover. Basically, people woke up and they figured out we have too much space. We don't need just in case inventory anymore. Or there's companies that took space impulsively because they had maybe the wrong projections for growth. The poster child of that is Peloton. I mean,
Right.
Yeah.
everybody, Peloton thought they were going to grow 50% a year for the next 20 years. And obviously nobody's buying Pelotons anymore. Nothing
Right.
against Peloton, but
Yeah.
it's just obviously
Return to a normal market.
return to normal market. My Peloton is at my home.
Yes.
It is now used to where I hang all my coats is on my
Yeah,
Peloton.
yeah.
Yes. And so,
Matt still uses his every day.
Yeah.
so,
Yeah.
yeah.
and so you don't
I'm
really
that
like,
rare customer.
Yeah.
exactly. And so the world's kind of gone back to kind of the normalized, and literally everybody just closed their eyes and woke up and they said, we have too much space. And when everybody is at all the same time, you have kind of that dramatic rubber band effect of shifting. We now have a vacancy rate now that's gone up 520 basis points. So our vacancy rate now is over 6%, where it was 0.5%
Wow.
in just 12 months.
Yeah.
We also have about 20 million square feet of sublease space
Ooh.
on the market. So
That's not included in that vacancy rate, or
it's some of it's including the vacancy rate, but most of it's not because it's included in the availability rate because
Sure.
it's still occupied.
Mhm.
So you have this rubber band effect, and we've seen, for the first time in 13 years, we saw negative net absorption. For the first time in 13 years, we saw negative rent growth. And these are all kind of situations that are all being driven by that COVID hangover.
Mm-hmm. Yeah, I mean, at some point, that market needed some sort of correction because you can't sustain 100% rent growth for multiple years, right? Like you guys were going at such a high clip that, it's probably kind of leveled out the market a little bit and probably needed it.
Yeah, and quite frankly, as you guys know, we do a lot of work both on the landlord side and also on the tenant side. We're here at a great conference here at IAMC, supporting a lot of our clients here on the occupier side. But it's really something that needed to happen.
Mm-hmm.
There was really, I wouldn't say there's not an exodus out of Southern California, but the change in rents made people rethink things. And we definitely had a trickle of people moving out of Southern California into Phoenix or Dallas or up
Reno
to
or
Reno.
whatever, yeah.
And it was a trickle. It's not a stampede. It's not a systemic issue, but it's definitely a trickle. And I feel like that trickling has slowed down a little bit because, tenants today feel like they're going to get a fair fight.
Mhm.
Instead of having the landlord have a big bat out and whacking him on the head, the tenant now has an equal way to fight. And they'll instead of getting beat over the head with no concessions and no TIs and no this and take the space, or
Be
you
lucky to take the space, right?
that's unnatural. Everybody, we've been in this business a long time. You always have options. You always have the ability to leverage those options to get a quote a fair deal. And today, I think tenants feel like they're back to a situation where they can get a fair deal.
Would you call it a tenants market there?
No question. No question. Yeah.
So in every cycle, Bill and I always debate this. So Bill
There's
never thinks
there's
it's
no
a-
like rate that you
Well-
can just be like,
well, listen.
point it's a
Okay,
tennis
so
market.
when Seattle climbed a couple quarters ago to 6%, I said it's a tenants market, and Bill said no way, right? Now it's 7%, and he's still not quite saying it. Right?
But you got to look at the historical average of what,
See?
like everyone gets caught up in like, oh, we've been at 1% or we've been at 3%.
Say it, Bill. It's a tenants market.
And, you got to look historically.
Oh,
it's
my
still
gosh.
pretty healthy, 6% is not bad.
Yeah, no, I can't speak for Seattle at all, but I can speak for the Inland Empire, and I can say emphatically it is not a landlord's market. And I don't think any institutional landlord. And again, the great thing about the Inland Empire is that there is a governor. Southern California is a very difficult place to develop things.
Yeah.
And capital markets in our world shut down before the leasing market shut down. And so about 15 months ago, nobody could get construction loans, or if they could, they were at, 12% or something crazy. So it was cost prohibitive to develop. And so basically all the demand, all the supply of buildings coming online has slowed down. So we're at a point where right now I think we have 18 million square feet under construction. Of that, 25% of it's pre-leased. And so we have a development pipeline that's going to come along. Normally we have like 25 million square feet under construction at one time. Now we're basically, if you take out the pre-lease, we're, 13 million square feet of under construction, and that's going to all get completed in the next 90 to 120 days. And so basically that supply side is the governor. Like there'll be no supply, there's going to be no new construction.
Right.
And basically that supply side is going to be the governor, where peak vacancies will happen somewhere in June, July of this year, maybe August, depending on how long it takes to get the new construction done. But then we basically need to chip away at the excess supply and kind of get through the excesses of COVID. And it's going to take some time.
2 questions on that, because to the listener, that sounds like a lot of construction. Taking out COVID and saying on a 10-year average, without COVID, what's the annual absorption-ish?
Annual absorption, annual construction are pretty similar. It's somewhere around 20 to 25 million square feet.
Okay.
And again, our market...
So you're not overbuilding by any means.
We're quite the opposite.
Yeah.
I mean, we've had unlike, some of these markets that don't have barriers to entry, like the Chicagos, the Dallases of the world, we have a beach.
Yep.
We have a very difficult government to entitle buildings in, and it's very hard to get things built. So there's natural barriers to entry, and then there's governmental barriers to entry, obviously the CEQA process being the number one. And it's a situation where it's created this really great balanced market for a very long period of time.
Yep. Quick question on every cycle has its problem, right? What's the problem in the Inland Empire? What's the size range and of the highest vacancy percentage?
So in our market, bigger is better.
Yep.
And I've been out talking to both investors and occupiers recently about the concept that not all sizes are created equal.
Yep.
In our market, let's just say on extreme, the million square footers, which is very in vogue, are, again, a nice Seattle company is back in the market for the first time in 3.5 years. Amazon has 28 million square feet in the Inland Empire. Just in the Inland Empire, Amazon has 28 million square feet. They have now come along and they're taking 4 more buildings. So at the end of the day, they're going to have, just in the Inland Empire, not Southern California, just in the Inland Empire, they'll have 33 million square feet of space. They're going to take 4 buildings totaling 4.5 million square feet. And that's new. That's like literally the last 60 days. Seattle company coming out of nowhere. And so that's really has driven a lot of other companies kind of take these million square footers to the point where now, as bad as the market is in certain smaller segments, I could tell you that there's actually probably rent growth going to happen in the million square footers, because when you have only one building in a 630 million square foot market and you have any kind of demand at all, that means rents are going up.
Yeah.
But if you look conversely in anything under 500, and we've done all the analysis, there's theoretically, almost in all size ranges, somewhere around 3.2 to 3.7 years of supply. So definitely the opposite, where, there's too many buildings and not enough tenants.
Right.
How's the fundamentals of where you're at? We're starting to see the investment market come back, especially in good core markets. How's the investment capital markets space? How are people looking at the Inland Empire right now?
Yeah, so the capital markets in the fourth quarter was broken. As
Yeah.
you guys probably saw in other places, I think we had a total of 16 deals go to market. All were mispriced. You don't know whether they mispriced it because the sellers' were expectations are low or whatever, but their bid-ask spread was too wide and none of them transacted. Well, fast forward to January, I think everybody woke up with a new lease on life. And so there's 4 deals out in the market price right now. One of the deals, actually, 2 of the deals received over 20 bids on it. Just vanilla, nothing special about these buildings. And those buildings are going to price. And what's good about that is not so much that the individual deals are going to price, but the fact that all 4 deals are going to price. And so for the first time in maybe 6 months, we will at least have some understanding of price discovery. And before, everybody was speculating, like the optimists were pricing it at X and the pessimists were pricing it at Y. And now for the first time in literally 6 months, we'll have data points that say, here is what the exact pricing is.
Yeah. It's nice to see, historically low volumes from last year. Now in the first quarter, second quarter, we're starting to see some stuff happen again, which to your point gives us great data to look at, and seeing money back out in the game is good too. So kind of wrapping it up, what do you envision the rest of 2024 looking like in the IE?
24 is going to be year of the tenant. Representing tenants is going to be
Hear that, Bill?
I did. Yeah. Yeah.
Representing tenants is going to be a lot easier, and as a broker or an advisor, you're going to be able to have a much better value add proposition in helping them, reduce their overall occupancy costs. I think 24 is going to be a situation where landlords are going to have to work really hard to secure tenants. Brokers are actually going to have to do their jobs on the leasing side, and it's not just wake up, put out a brochure, and then have 10 people show up on your doorstep. You're going to have to do kind of the fundamental things that are necessary to get buildings leased. And so it's a year where I think we're going to kind of go back and figure out what a new normal is. Now, 24 is not going to be a normal year, but we're all hopeful that somewhere in 25 or mid 25, we'll kind of get back to the, given the fact there's no new supply coming on the market, we'll kind of get back to kind of that new normalcy.
Awesome. That is a great overview. Thank you for sharing your insights. Nobody better to do that than you.
Clearly.
On the Inland Empire.
I would say Steve knows his market. Dan was excellent in Vegas. These two probably are the best market experts in the country.
Yeah, I'd have them at second and third behind us. But yeah, it's definitely top three for sure.
Well done. I'm always happy to take a back seat to you guys.
No, man, thanks so much. You're awesome as always, and we'll keep an eye on the IE.
My pleasure. Enjoy the balance of the conference.
Thanks a lot.
Yeah.
Thanks a lot.